This is one of many training videos we're releasing explaining the packages which are available as part of the Countrywide legacy software which is being developed by Countrywide Tax and Trust Corporation Limited.
Company wills and cross-option agreements. A company will really is another terminology for a cross-option agreement. There is no separate will that clients need to have. Their own personal will accommodate their business assets, and that will be covered in an alternative slide session. So here we have a situation whereby we have no cross-option in place at all. This will be a common scenario that you may come across. We've made it nice and easy. We've got two directors here. They both own ABC Limited equally. In this case, we've also just elaborated they've got a standard will each. If we run through a scenario now that sadly there is a death, and the will of the deceased there, as you can see, has then directed, amongst everything else, his business share to his spouse in this scenario. And of course there's a range of questions that are highlighted as to the implications on the business, ABC Limited, and indeed the implications on the wife that's inherited it, and of course the implications on Director B. There's also a situation there to possibly consider that the clients may not even have a will at all, and of course then the business could be subject to the intestacy laws, and that can have even more complexities there because it may not just be the wife who inherits the estate, it may actually be children. And of course if there is no spouse at all, that could go to children or indeed other further distant family members, all impacting on the business and again Director B. And there's some points there to highlight with Director B. He may try to continue to run the business and part of the dividends and income that's generated by that business he's got to pass over to the beneficiaries of deceased Director A. Now of course businesses don't necessarily be simply owned on a 50-50 basis with two directors, so we need to consider also this possibility where there is an unequal split of the business ownership. So we now have an unequal split. As you can see, Director A has 70% of the business and Director B has 30% of the business. Still noting, of course, we still don't have any cross-option agreement in place here. So in this scenario, we've now got Director A passing away and 70% of the business now passed to his wife. We have all the similar questions as we had on the initial slide, but also there's some further issues to consider as it alludes to here at the base. The wife now has a controlling share of this business, and of course she could change that dividend structure. She has any casting votes in terms of what happens to the business, and of course she is in a position to sell her share of the business to someone else as well. Again, we have the implications as previously covered in terms of intestacy as well. In terms of Director B, of course, as you can see, he has little or indeed probably really no control at all. His 30% of the business is also probably not worth that 30% either of the value of the business. So that's something to be mindful as well. And of course, the implications on the dividend income could well indeed be changed. So there's significant points all around here. Or of course, we could have a situation where Director A has 30% of the business and Director B has 70% of the business. Again, we have Director A passing away with his 30% now. Again, all the same issues as we had in the first place when we were 50-50, but also now we have to consider that the surviving spouse has little or no control on this business at all. Again, her 30% probably is not going to be worth 30% of the value of the business, and of course any income that she is potentially going to receive from Director B is controlled by Director B. And again, the implications there with intestacy laws. But then when we look at Director B, he probably wants to continue to run the business. Now, is he going to want to provide that 30% share to the surviving spouse of Director A? Probably not. And as the question suggests there, is he likely to want to perhaps go and start, let's say, DEF Limited and start a new company and take everything with it with him? So in essence then, as you can see, what really is the value of ABC Limited at this stage? So again, to reiterate the point, Director B now has the controlling share. He can have control on the dividend structure and so forth, and of course he has the casting vote, and he could indeed sell his share to a third party. So clearly, hopefully we can see that we've got to consider some further planning here, and this is where a cross-option agreement comes into place. As it states there, you've got to consider the financial consequences to everybody, notably the deceased beneficiaries and of course the surviving director. Now clearly I would suspect the surviving director would want the option to acquire the deceased shareholding. He may want to continue that business. In that concept, of course, there needs to be some funds for him to acquire that share. It's highly unlikely the surviving director would have those funds. Now clearly, on a deceased beneficiary passing those shares to the surviving director, they want to be compensated by those funds as well. So as it states at the bottom, there's probably got to be a likelihood that life assurance policies are going to need to be established. We now have a situation to possibly consider that there are companies out there who may have got a standard routine cross-option agreement in place, maybe from a local high street bank or indeed high street solicitor or the legal firm. This is as good as we possibly see, but ultimately not what we recommend. So we have here ABC Limited again, and both directors 50-50 share of that, and that share that they have is 1 share each. Quite commonly there are life policies established, and generally they are owned by the company. They are not owned by the directors individually or independently. Again, we have beneficiaries, spouses and the like, and we have a death, and again through probably a standard will at best, the deceased's spouse inherits that 1 share of the business. The life policy proceeds are paid out from the life policy, and they're now owned and on the balance sheet of ABC Limited. The cross-option agreement is then executed, and now ABC Limited is actually only now made of 1 share. When a business acquires its own shares, they are cancelled. So we now just have 1 share of ABC Limited, of which Director B is now the sole owner of. As you can see, the life policy proceeds are now with the deceased spouse. With the relation to those life policy proceeds that are now with the deceased spouse, she may find very happy with those funds, but we need to highlight that those proceeds now are at risk from her subsequent remarriage, a subsequent divorce, maybe any creditor claims, future long-term care fees, and of course it's also increased her estate and maybe either creating or worsening a further inheritance tax liability on her death. So now we also have to consider the impact on the company itself and Director B. He now owns the whole of ABC Limited. He has that 1 share. Now of course that business, if it continues, generates income. Of course that whole business is attackable from his personal divorce. He may have creditor issues, future long-term care fees, and of course if he now sells the business because Director A has died perhaps, CGT, capital gains tax on the whole value would be applicable. Of course, if he's then sold that business and then subsequently passes away, the cash proceeds clearly would not meet any criteria for business property relief, and of course those cash proceeds could be subject to inheritance tax as well. Right, let's put some numbers on this. We're going to look at the capital gains tax issue here first. Again, Director A and B, their business, they've established it at outset. They have a share each, and each share is £1, and again we've got 50-50. Let's say over time business does really well and the value of the business has now gone up to 1.8 million. So as you can see, their respective shares are now £900,000 each. They've got off the shelf from a high street solicitor or bank, let's say, a cross-option agreement, and as explained previously they have a policy each for which is owned by the company as well. And they've got sums assured of £900,000 on those policies as well. And as you can see, we've got the cross-option agreement also drafted. We then have the death, as explained previously. The £900,000 share has now gone to the deceased spouse, and the £900,000 life policy is now owned by ABC Limited as well. We now have the cross-option, so Director B has acquired Director A's share from Director A's spouse, and as stated there, the business of 1.8 million is now owned by Director B, and the £900,000 life policy proceeds are now with the deceased spouse. So looking solely at the CGT issue, Director B says I'm now going to sell my business, and as it says there, the whole business now is going to be subject to the disposal for capital gains tax. So to illustrate the point again, Director B's share at outset was worth £1. It went up to £1.8 million. So on selling the business, the disposal is practically £1.8 million in gain. Potentially entrepreneurial relief can apply, and let's assume it does, and so that tax rate is 10%. So 10% of 1.8 million is £180,000 paid to the taxman, and now Director B is going to be left with 1.62 million. So now let's look at the inheritance tax issue. Again, we've got £1.8 million worth of ABC Limited, 900,000 value of share for each director. We have a death. The 900,000 share goes to the deceased spouse. The 900,000 life policy proceeds are owned by ABC Limited. We have the cross option being executed, and we've now got £900,000 with the spouse and 100% ownership of the business with Director B. So arguably on the spouse's subsequent death, the £900,000 at 40% could be creating a further £360,000 worth of inheritance tax. Meanwhile, as previously discussed, let's say Director B sold ABC Limited and he was left with a 1.62 million after the capital gains tax entrepreneurial relief applied. So 1.62 million at 40% creates a further £648,000 of inheritance tax. So combined, out of that £1.8 million business, in excess of £1 million has been lost to inheritance tax just through the circumstances they had. So if you add that on to the capital gains tax of £180,000 that was also paid when Director B sold the business, it's £1.188 million. Okay, so now let's look at the solution that Countrywide Tax and Trust Corporation would recommend. So we build the scene here. We've got, again, ABC Limited with the 1 shares of each director, their 50% share. Individually, they will have a will, and they will then also have all the appropriate trust they need. Included within that, their will needs to have a business clause within it, directing those business assets to further family business trust or trust plural. And as you can see, both directors would have such planning. There is alternative webinar training slides that will explain that further. Meanwhile, we also have the life policies also established for each director, and that may be multiple policies depending the value, but for the sake of this particular slide we're just making it simple and showing a 1 policy and 1 shareholder trust. But ultimately, in reality, there may be the necessity to have multiple policies and multiple shareholder trusts. Those policies are assigned to the shareholder trusts. We now have a death. The will of the deceased directs the business shares to the family business trust or trusts. The life assurance proceeds are now paid to the shareholder trust, not to ABC Limited. The cross option agreement is now executed, and as you can see now, the life policy proceeds are now held in the family business trusts, and the deceased share is now held in the shareholder trust or trusts. Now, in talking about the business trusts, those policy proceeds are now protected from Director A's remarriage, credit claims, care fees and future inheritance tax. The deceased share of the business now in the shareholder trust are also protected from Director B's marriage after death, credit claims, care fees and inheritance tax. Clearly, Director B still solely owns his 1 share of the business. So once again, let's see what Countrywide solution has an impact on the capital gains tax situation that was previously described. So again, we have Director A passing away, his share of the business directed to his business trusts that were coordinated with his will. The cross option occurs once the policy proceeds have been paid out to the shareholder trusts. So as it says there, shareholder trust acquires the deceased 900,000 share for 900,000. So there's no gain there. Now if Director B decides to sell the business, it's only his personal share that has increased from 1 to 900,000. So there's a gain there, clearly. Now the gain on 900,000 at 10%, assuming entrepreneurial relief again, is 90,000. Now on the basis the 900 share of the business that was acquired at 900,000 by the shareholder trust is sold for 900,000, clearly there is no gain there, and hence of course no capital gains tax applies. So we've immediately reduced the original £180,000 capital gains by 50%. That 50% is saved purely because we've got the right structure in place and the use of Countrywide trusts. So now let's look at the inheritance tax issue. Again, same structure. We have a death. The 900,000 share of deceased's A has gone to his business trusts, coordinated with his will, and we've assumed business property relief applied, so no IHT applied at that stage. £900,000 life policy is paid out to the shareholder trusts. Cross option occurred. And as those policy proceeds now are in the family business trust of the deceased, clearly he would have chosen his spouse, his children and anybody else to be the potential beneficiaries of those discretionary family business trusts. So none of that £900,000 worth of proceeds will be in any of their estates to impact on their personal inheritance tax liabilities. Once more we look at Director B, who sold the business. And as you will recall, he will now have £810,000 worth of cash in his own personal name after the CGT had been paid. So on his death, admittedly, that £810,000 could create at 40% £324,000 worth of inheritance tax liability on his death. The proceeds in the shareholder trusts are not part of Director B's estate, so will not be impacted by his inheritance tax. So again, purely because of the structure of the cross-option agreement and all the associated trusts, the inheritance tax liability could be £324,000 in comparison to in excess of £1 million. So we've saved nearly £700,000 worth of inheritance tax. And of course, in relation to the £324,000 of inheritance tax that could be liable on Director B's death, of course further planning could be established to negate that fully as well. So when we look at the combined savings of inheritance tax and capital gains tax, £414,000 would be payable in comparison to the £1.188 million. So combined, that saving is £774,000 capital gains tax and IHT that's been saved just by having the appropriate structure of cross option and all associated trusts with their wills and the shareholder trusts with the cross option agreement. Okay, also an issue to bear in mind, and it's very overlooked, is the income tax issues and ultimate benefits by using Countrywide's structure of shareholder trusts and business trusts with the client's wills, and indeed obviously the cross option agreement itself. We're starting a point here where sadly we've already had one of the directors pass away, and as you can see his respective share, once the cross option agreement is executed, is now held by the shareholder trusts. And Director B is a trustee, so in control of the shareholder trusts along with Countrywide to provide the professional guidance and advice. ABC Limited continues to trade, and as you can see is generating an income. As it says there, 50% of the income is now trust income, and of course trusts are subject to tax, and as it's stated as a rate applicable to trusts. As you can see, Director B, he continues to receive his 50% of the income as normal and as obviously subject to his own personal income tax rate. Now, on considering the rate of income on the trust, the first £1,000 worth of income is taxed at 20%, but thereafter it's taxed at 45%. And obviously there's a question mark over whether that is as tax efficient as it can be, because that is the highest rate, of course. So let's look further at the shareholder trust that's in place at this stage, with, as you can see, 50% of the business, which in essence is Director A, the deceased share. And then let's think who are the potential beneficiaries of that trust. Well, they would be the surviving director himself, chances are his spouse, his partner, and any further children and beyond. That would have been their call when they first established the trust. Now it poses the question, is some of those other beneficiaries there, well, what is their income tax rates? Are they taxpayers at all, or do they just pay perhaps base rate? Certainly do they pay less tax than a trust would pay. So if we go to the income consideration again, where we thought the income was going to go into the trusts, well actually the trustees, which again were Countrywide and Director B, they could consider mandating the income that was due to the trust to any of the beneficiaries of the shareholder trust. And this is where the guidance from Countrywide Tax and Trust Corporation can be invaluable, because this would probably be our consideration. It may not have even been a consideration of Director B. He may not have even known how to do this. So as you can see, he would continue to receive his personal income, and the 50% income now is being mandated from the trust to any one of those or more of the potential beneficiaries of the trust. So, to recap Countrywide Tax and Trust Corporation's solution, each director should have an appropriate will with business clause within it, directing their business shares to business trusts. There needs to be a standalone shareholder trust or trusts into which their life policies are assigned into. And so when a death occurs, the deceased share is directed by their will to their business trusts. The life policy proceeds are now held by the shareholder trusts. And the cross option being executed, the cash proceeds are now in the family business trust of the deceased, and they are now all protected from the beneficiaries of Director A, their remarriage, their divorces, their creditor claims, their care fees, and indeed their inheritance tax. Meanwhile, the deceased share of the business is now in the shareholder trust, and as such is not in the estate of Director B, so is protected from his divorce, creditor claims, care fees and inheritance tax as well, and he just has his sole share. The further point is, of course, any income and dividends can be mandated to any of the shareholder trusts beneficiaries, such as children and beyond, and of course could be utilised for all sorts of issues, notably things like school fees or university fees.